What type of loan is right for you? Let's make this simple. So a lot of people obviously think that they need like 20% down, perfect credit to be able to buy a home. And that's just simply not true. And you've been lied to, and that lie is costing you thousands and thousands of dollars. So I obviously have been working in mortgage for over 20 years. I have seen all kinds of different loan products, programs, types, and I'm going to break out kind of some of the most popular and just give a very brief rundown of why they may fit for you so that you can just be able to help figure out what might be a perfect fit for you. So let's start with the basics. These are the basic loan types, and you may have heard some of these tossed around and some that's a little bit confusing for people, but a lot of people just don't do a good job of explaining it plainly. So for instance, FHA. So FHA loans are great loans for people that maybe don't have as great a credit. That is not usually as much of an issue with FHA. People who do want a very low down payment, 3.5% is usually all that is required there. They are backed by the government, and they are made for buyers who need a little bit of flexibility because they're a little more forgiving also on what we like to call in the industry debt to income ratio. This means how much debt you hold and how much income you have. And so they're a little bit more on the flexible side there. A lot of people think of them as a first-time home buyer loan program. That is not true. A lot of first-time home buyers do use that loan program, but they are not exclusively a first-time home buyer loan program. So if you are buying a second, third, fourth, fifth house, you absolutely can do it. You can use FHA. There is limits to loan limits on how much money you can borrow through FHA, and they do change every single year. And so if you're wondering what those are, you literally can Google FHA county loan limits, and depending on what county in the country you're in and what year you're in, will depend on what those look like. Okay, so that's the easiest way. Can't sit here all day and give you all kinds of information. I'll try to put a link on where you can find the county loan limit, so that makes it a little bit easier. So that is probably one of the most common loan programs and something that we get a lot of questions about. Okay. Up next, we're going to talk about VA. So what is VA? VA actually stands for Veteran Affairs. So it is a veteran affiliated loan. So this is any active duty service member, a veteran, or somebody who has been a reservist that has served a very specific amount of time. And a caveat, if you're a reservist, we have to make sure you have all your points. If you do not, it can really bite you in the rear end. So you may qualify, you may not. Make sure you get with an expert who can go ahead and pull ahead of time your eligibility to make sure that it's not going to be a problem. These loans carry zero down payment. So there is no down payment that you have to bring to the table. That doesn't mean that you don't have to bring anything. There is still going to be closing costs and things on a loan, but you do not have to put any money down. But these loans are exclusive. You cannot get them if you have not served our country. And by the way, thank you so much for that. My husband actually served. He's 100% disabled veteran. So thank you so much for your service. Okay. Next up is going to be USDA. USDA, and now you're saying like the meat? Yes. Same department. Okay. What this is a special kind of loan for people who want to live in rural areas. Okay. The USDA is what determines the eligibility for the property. There are some income requirements that you have to meet in order to be there, aka you can't make like loads and loads of money. Why is that? That's because these are a 0% down loan program as well, similar to VA, but the property has to fall in USDA eligibility. There is literally a website. You pop the address into the website and it will tell you if it is USDA eligible or not. Okay. Sometimes areas that you wouldn't expect to be considered rural are considered rural. And sometimes areas you would be like, that totally is rural and it's not USDA eligible. But the USDA is who sets it. So don't blame your expert, blame the federal government, because guess what? That's who's making the determination, okay? Next up, you're going to have conventional. This is going to be a loan that is typically backed by Fannie and Freddie, and this loan is going to be for people who typically have a little bit better credit history, okay? And they typically may have a little bit more money. You can do a conventional loan if you're a first-time home buyer with only 3% down, but traditionally it's 5% or more, and it is a great loan program. Again, the conforming loan limits, that is going to be what determines how much money you can borrow at a maximum. These do change based on state and county and the year that you are looking up those limits. So they do change every single year. In fact, if you're friends with any mortgage experts online, I guarantee you, usually around November-ish of every year, you're going to see 8,000 posts about what the new conforming loan limit is. That's what they're talking about. They're talking about the maximum amount of a conventional loan that you can take out. So, what happens if you need more money than what a conventional loan can offer you? Oh, and caveat, FHA is always lower than a conventional max limit. Okay. So if you need to buy a pretty expensive house, FHA is not always going to be the go-to there. Now, jumbo, that is going to be if you need more money than what a conforming loan or conventional loan can offer you. Okay. So that is going to be when you are purchasing really big, expensive properties for your particular area. Okay. Not necessarily nationwide, because I know expensive is in the eye of the beholder. Some people think $500,000 house is expensive, and some people think that that is reasonable or cheap, right? It's all in how your area looks. But understand that when you exceed a certain threshold, that conforming loan limit, which is very easy to search for, then you're going to move into jumbo or non-conforming territory. These loans are going to hold a lot more restriction. They're going to hold more restriction on how much percent you have to put down. Okay. They typically are at least 20%. There's occasionally times that's not the case. These also are going to be loans where, you know, the amount of money you make and versus how much debt you hold, it's going to be a lot stricter, a lot tighter. They also sometimes are going to require you to have a certain amount of money set aside. We call that reserves, to make sure that you can continue making payments. Why is that? Well, that is because those loans are typically backed by private investors, and so they can make more strict requirements. They can say, we're not willing to do this loan if we don't have X, Y, and Z. Okay. And so that's the whole reason. There's also a loan that kind of, jumbo is also non-conforming loan. There's also something called non-conforming loans or non-QM loans. These loans are loans for people who may not traditionally qualify. So maybe you're self-employed and you don't show enough verifiable income. You might qualify under some of those kind of buckets. Understand, due to the fact that they are a higher risk loan, they typically will require more money down. The thing that I always tell everybody, when you are looking at getting a loan, depending on what your risk factor is going to depend on how many and what options you're going to have. The higher risk, the more money they're usually going to want you to put down, the higher potentially the credit score, things like that. Doesn't necessarily mean that we can't find a bucket for you to fit into. Just understand, you're not going to go to any expert and have completely trash credit, no verifiable income, very little money down, etc., and get a loan. It's just not going to happen. Okay. So be realistic and understand that homeownership is 100% within the realm, but there are different products for different people, and we need to help you match what may make sense. And if we're not totally there yet, how do we get you there? I always tell people this: if you want to be a homeowner, the answer is not no. It might be not now, but the answer is not no. We can get you there. If you're willing to put in the work, you're willing to do what's necessary, I promise we can go ahead and pull you across that finish line and get you where you need to be. Okay. So now we gave you like the big overarching picture of what the main loan types are. Now let's talk for a minute about the loan lengths, or the terms, if you will. Okay. So here is going to be your typical loan terms when it comes to borrowing that money. You typically are going to do two main buckets, and that's going to be a 30-year loan term, meaning that you've got 30 years to be able to pay that, or a 15-year loan term, which means you have 15 years. That's how long they stretch out the payment. There is other options like 20 or 10-year. I would say that 30 is definitely your most common, but for some people, 15-year is a really great solution, right? And so how do they differ? Well, the 30-year is going to be the lesser payment and typically the higher interest rate. The 15-year is going to be a lot more payment and typically a little bit lower interest rate. Okay. And there also is two different main loan bucket types. There is fixed interest and adjustable. So fixed means that the interest rate for the entire duration of that loan is not going to change. The payment might change due to taxes and insurance changes, but the actual interest rate itself, which is calculating the principal and interest, that's fixed. It's not changing. Okay. Adjustable, otherwise known as an ARM loan, it stands for, it's an acronym, adjustable rate mortgage. This loan type can either adjust monthly, if it is what we like to call a pure arm, or more commonly is something called a fixed period arm, meaning that it will be fixed for a set amount of time and then it will adjust after a certain set amount of time. So that could be 3 years, 5 years, 7 years, 10 years. Depends on what kind of arm loan you have. Arm loans got a really bad rap back when the crash happened. They're not necessarily bad loans. They're just not for every person. This again is where I'm going to tell you, you need to be tapping an expert, because an expert is going to be able to help you look at whether an arm loan may make sense for you or not. They're not bad products. They're just not for everyone. And unfortunately, prior to the 0809 crash, there were a lot of loan officers that were just stuffing people into arm loans, not explaining how they were going to work. Really, really upset me, actually. In fact, I will tell you the story. I worked for one of the largest lenders in the country. Okay. Literally, I think at the time they owned about 1 out of every 3 mortgages nationwide. That's a huge market share, guys. And I was in this call center, and I'll never forget, there was a woman that I was working with, and I heard her get off the phone, and I noticed that based on the way she was talking to the customer, she seemed a little bit confused. And so when she got off the call, I said, "Hey, can I ask you, do you know what all those numbers mean?" And she's like, "What numbers?" And I said, "The numbers that are coming after the product type." And it said like 7/1 and then like 5-2-5, and then an acronym that she didn't know what it stood for, but it was letters and it said LIBOR. And she's like, "Oh, what? No, I don't know what all that means." Okay, so here's somebody who's selling these arm loans, doesn't really have an understanding of what any of those things mean. Those are really important details. And so unfortunately, the reason a lot of people got in trouble is they just didn't really understand what they were getting into. So I'm not necessarily saying that an arm loan is a perfect loan type for you. I'm just saying that if you have a true expert in your corner, they can look at those choices for you and advise you accordingly. But those are going to be your main kind of buckets. So a lot of times what a lot of people don't realize is that there are thousands of product types. So most mortgage experts only use probably a small little bucket of loan types for all of their clientele. However, there literally are thousands of loan types. And so if you have a unique situation, there is often a product for you. It just may not be exactly the product you like or want. And so again, this is where education comes in, because you can then decide, right? What's more important? We had a client a few years back where they were self-employed and they wanted to move from one state to another. And the only way that we really were going to be able to get them qualified was to do a non-QM loan type. So what did that mean? That mean they had to put a lot more money down and the interest rate wasn't super pretty. And so I just sort of explained to them, look, here are options. We can go ahead and try to wait until your income is more provable so that I can put you in a more traditional loan process, right? Or you can understand that you are a higher risk loan because we can't prove all of your income. And because of that, there's going to be certain things that we need to accomplish, which is more money down and a higher interest rate for that risk. So just understand that there is not necessarily a bad product. I'm an unusual mortgage expert and that I really don't believe that there's bad products. Every product was created for a purpose. It just may not fit you and it may not fit your unique set of circumstances. And so when making these decisions, this is why we really need to tap the expert to make sure. And so again, this is where the education piece comes in, because I have people who come to me all the time and they believe that they have to have 20% to put down. And not only is that usually not the case, usually you can put possibly as low as 0% down all the way to maybe 5%, something like that. But you don't know what you don't know. And your situation is unique, just like you are. And you should have experts that are looking at you with that uniqueness. And that is why it matters so much. And so, I've literally had clients that have almost given up because they really thought that was no product for them. And when we dug in and we really figured it out, there was some options there. Or she could take a pause and we could work on a few things and we could put her in the position where she'd have more choices. Right? And so this is what it's all about. It's just about education and understanding. And so which loan is right for you? I don't know. This is not something that you Google your way through, right? This is why you watch videos like this one and get some good information and kind of a jumping off point. It's why you reach out to myself and my team and you schedule a call and you have kind of a fact-finding information session to figure out what will work for you. And so feel free to reach out to us. You can literally go to pbjteam.com. You can book a call if you want to kind of understand a little bit more about what your unique situation is and how we may be able to help you. Our ultimate goal really is just to put you in the best possible position. That's really all it is. And so understand that whatever that looks like, that's what we're going to do. And if the answer is not right now, that's also okay. We will give you the steps and the tools and to fix the situation. And only you can decide if you're willing to put in that work to be able to get it. Because I joke that we will get right in there with you and we will help dig your way out of the hole, but you got to be in there with us. And you can't be adding dirt back into the hole and creating more challenge for us, right? We have to be on the same team. We have to be working together. So hopefully this gave you a really good overview of what these different loan products and types kind of look like so that you can be able to find that perfect loan match.